Recently, I got a question from a subscriber asking me if DeFi is dead. With volatility going down across the board, fees have compressed, yields have dried up, and as a result, the fundamentals of some of these DeFi projects are looking a lot worse. And if you want to earn even a sliver of yield, you have to go at the risk curve, risk getting rugged, or play the airdrop game, which is kind of a crapshoot. And I generally agree with this sentiment. I think being in crypto, being in DeFi is really exhausting right now. It's really hard to remain engaged. It's really hard to be optimistic. And it got me thinking, and I've been thinking about this for quite some time now. And, is DeFi dead? And like, if it is dead, like what's it gonna take for DeFi to come back, right, to greener pastures? And this is what I want this video to be focused on. So, feel free to strap in, grab some popcorn. It's gonna be a longer video, but I'll have timestamps below so you can navigate through the different sections. So since May 2022, or June 2022, the stablecoin TVL, like on-chain, has been flat, meaning that, okay, like maybe there's enough value for people to not want to bridge out, but people we're not really seeing like an influx of people wanting to bridge capital from off-chain to on-chain. And until this gets to its previous all-time highs, I don't really think we can call any pump in the markets a crypto bull market. And I think only like a real DeFi bull market only happens once we get above, let's say, 200 billion in market cap, and eventually you reach $1 trillion. And I think that's why we're all that's why we're all here in the space. That's why my channel exists, because I truly believe that this can happen. And of course, I know that price went down like in the past couple of days, but generally, this is the Bitcoin volatility index in blue, and it's been at its all-time lows. So, prices aren't moving, no one's really using applications, and as a result, what value do these applications have? And if you think about it from like a big picture perspective, I think what we learned is that these blockchain native applications have difficulty creating sustainable value, because most yields, like sustainable yields in crypto, come from fees. And why do people pay fees? Well, maybe because there's market volatility, maybe because it creates value. But if you kind of think about it, like if you kind of simplify it, it's just money going from one person to another person. And if there's a lack of capital inflow, then it's like no new value is being created, right? Like we're not really playing positive sum games. Like these are zero sum games. And in order for DeFi to come back, we need some positive sum game that benefits everybody, that creates value, that people actually want to deploy capital on. Another form of yield is inflation tokenomics, and I think people understand by now that it's not really sustainable, and by definition it's a fragile system. It's great when money is flowing in because things are going up, but when money's not going in or money's leaving out, everything just looks really bad, and that's where we are now. And this is the agenda of the video. I'll introduce this concept of DeFi Antifragility and the death of old DeFi, and then I'm gonna coin a new term. I guess we're at the at the phase where Taiki is coining new terms now, and I think there's this new DeFi 3.0, which I think is how DeFi comes back stronger. So, let's get right into it. None is financial advice because I have no idea what I'm talking about. So, DeFi Antifragility. So, I'm sure you've heard of the term anti-fragile by now. There's books written about it, but there's like three different, forms of like fragility where, like a system that can suffer or break easily from volatility. And I think DeFi is kind of in this camp of fragile and like resilient, but it's not truly anti-fragile. You can even argue that crypto itself is not anti-fragile yet. Of course, it has survived like 15 years. It survived like all these exchanges going bust, like FTX, Luna, 3AC. But in order for the system to be truly anti-fragile, it has to be around for multiple decades, and it has to create value for millions and billions of people. And then like until then, I think we're still in this resilient camp. But like, how do we get to anti-fragile, right? It's gonna be hard. Like, how does the system grow and like get strong from volatility, from all the shocks that it's experienced? And that's kind of the theme around this video, because in its current form, I think we learned that DeFi can't survive these high interest rates and or low volatility environment. And as a result, the entire system is fragile to the lack of stablecoin demand. The Fed started raising rates March of 2022, and ever since then, TVL down. And I think, I've written about this many times, and I feel really strongly about this, but I think that until on-chain yields that are perceived very safe can offer higher yields than the risk-free rate, we can't have a sustained DeFi bull market. I think this is the prerequisite to a DeFi bull market. It's not meme coins pumping, bringing retail back in. No, I think what needs to happen first is for stablecoin yields to go up across the board, enticing more and more capital to remain in the ecosystem and come into the ecosystem. And then we can play like on like new projects, new tokens, because there's like more, I guess, like money within the ecosystem that, you know, people can like make money out of, I suppose. And if you go like a step further, I think that DeFi needs its own risk-free rate, right? Like we don't need like 20% stable, 15% stablecoin yields that go down in 2 weeks. No, like we need, you know, 10% yields that stay flat for like 5 years, right? I mean that sounds insane, right? Like that really sounds insane. But I think there is a path to get there, and you know, like this is how DeFi becomes anti-fragile. And you know, kind of repeating the same points, we need to keep stablecoin liquidity sticky, have stablecoin inflows exceed outflows, and you know, it's not going to be meme coins. It's to create better products that incentivize people to encourage this behavior, right? Like we can't just tell people to remain in crypto because it's going to pump again with the halving. We can't say that, you know, meme coins are going to create billionaires. No, like we need to create better products. And this is where the rise of DeFi 3.0 comes in, right? Like how do we create better products? And yeah, so I argue that, you know, DeFi 3.0, it's not, because right, I mean, of course, like when there's market volatility and like printing new tokens and people buying it, you know, it can work, right? You know, people can make money, like yada yada yada. It kind of works, but to make it a truly like anti-fragile system, we need a system where it doesn't rely on new tokens, it doesn't rely on market volatility, and it doesn't rely on like interest rates going down. And it's all about creating sustainable sources of yield that's, you know, separate from crypto native forces, and you know, whether, you know, like whatever's happening in the world, we just like need stable like yield sources that people can rely on, and this is like where DeFi 3.0 comes in. So, you know, DeFi 3.0, it's a system that can survive periods of high and low market volatility, high and low interest rates, and also risk on and risk off periods. Okay, like I mean, this is TradFi, I argue, is anti-fragile, and you know, DeFi needs to get closer to TradFi and even offer better products than TradFi, right? That's anti-fragility. You know, stablecoin TVL flat, and you know, I've been talking about this concept of real-world assets and tokenized treasuries, and the entire idea, and the entire thesis, and the theme of my idea, right, DeFi 3.0, is that crypto native applications can't create value within its own ecosystem. It's like not good enough, right? It's just like not good enough, right? We need to be real with ourselves. It's not good enough. So if that's the current result, like if that's the meta, then I think we need to import it from external sources. Okay, so off-chain yields to feed the on-chain economy, and that can in fact create value. Okay, that's kind of the idea. So before I get into the concepts and the projects and the tokens, I want to give a quick disclaimer, right? And just say that, you know, I think of DeFi 3.0 as a framework. I've been talking about, you know, certain projects like MakerDAO, but, you know, I view Maker as like a vehicle for DeFi 3.0, as, you know, like the best, I guess, liquid token to like bet on that narrative for now. But like, I mean, the goal of this video is, I also want this video to be anti-fragile, right? I want this video to be like seen by people 6 months from now, and you know, think about and like onboard more people to like, you know, buy into this new idea. But you know, 6 months from now, like maybe Maker is like less relevant, right? And maybe there's like a new project that's like doing better. So you know, don't focus too much on like the individual projects. I'm going to talk about them because I mean, there's like nothing else to talk about, and there are steps being taken to, you know, create better products that I've talked about. But you know, for me personally, I think of it as a framework, and in the coming months, even coming years, I'm gonna, you know, frame like my investing and farming strategies around this framework. Yeah, and you know, for example, like there's this new protocol called T protocol that I think is pretty interesting. You can participate in the testnet campaign, maybe get some airdrops, and I mean, I might participate in the IDO depending on the valuation. It's also like a tokenized TVL project. So you know, I'll talk about Maker a lot because I'm going to get a bunch of questions, and I've talked about it before, and I hold Maker for these reasons. And you can also agree with this idea, but like disagree with the idea that Maker is a good hold, right? So like I don't want to like focus too much on the token price and like the token like itself. But it's just giving a general disclaimer here. But I do like Maker, and I'll talk about it. So like real world assets, there's a growing trend of projects that's buying T-bills off chain, tokenizing it, and bringing that yield on chain. And of course, if you're like a US customer, like maybe that doesn't create that much value because you can go to Fidelity. But I think the permissionless nature of blockchains and giving anyone access to dollars and the risk-free rate, I think that's a pretty good value add. And I think adding financial engineering on top can even make for better types of like products. For example, right now, this is MakerDAO. You can stake DAI to earn 8%. This is gonna go down to 5% on Monday, I believe, or Tuesday. And like most people, it's like most people are like it's like Justin Sun depositing like 100 million DAI, Olympus DAO. I mean, there's like a raft. I mean, yeah, it's like mostly like whales participating in this. But like imagine like 8% yield on dollars. Sustainable. I'm sure like that's going to bring more capital on chain, right? I'm sure that's going to bring or that's going to keep stablecoin liquidity stickier. And right now this isn't purely sustainable, but I do think that or I'll go through the ways in which like where these rates can be sustainable. And yeah, I'll talk you through it. With the DAI savings rate going up from 3.5% to 8%, and it's going to go down 5%, but I still think the DAI supply is going to keep growing. In the past couple of weeks, the the market cap of DAI has gone up by $1 billion. And like I mentioned, there's a new proposal. I think it's going to pass Monday, and it's going to lower the DSR to 5%. So in the future, you can stake DAI and earn 5%. And if you think about it, this is now the risk-free rate of DeFi. Because I think by now people generally trust the peg of DAI. It's been around over 5 years, and it's had its problems here and there. But I think it's like earning 5% on DAI, like a fixed rate on DAI. I think that's a pretty good proposition. And I think whether you like it or not, this is currently the risk-free rate of DeFi. And Maker, like for now, right? It's the on-chain Federal Reserve. Okay, like if you're a DeFi project and you can't offer like a stablecoin yield of 5%, no one is gonna like deposit money into your protocol, right? There's like no way, and the token's gonna go to zero. It's kind of like staked ETH, right? If you can earn like 4 or 5% like staking ETH, then like why would you deposit money into like some random DeFi protocol that's paying 3%, right? It makes no sense. So it kind of raises the bar for DeFi rates across the board, and it naturally brings yields up too, right? Because if you can, for example, borrow USDC at 4%, then you can swap it to DAI, earn 5%, and that's like a relatively risk-free arbitrage. So it's going to bring lending rates up, and generally the yield on chain should go higher. And I know what you're thinking, right? 5% is not good enough, right? I can earn 5.3% on Fidelity. You're stupid. I agree, right? I personally own some T-bills myself. Okay, like for sure. But let's talk about how do we create superior products, right? Because we need to beat TradFi, okay? Like DeFi needs to beat TradFi. Otherwise, people aren't gonna, like put millions of dollars and billions of dollars into this. And I think that, with DeFi money Legos and composable smart contracts through DeFi blue chips and like applications people trust, right? Like not like new stuff. I think, you can actually create value on top of the risk-free rate and then create demand and value. So there's this new proposal on Aave forums that should go live on the 19th. It's gonna pass. I'm like 95% sure it's gonna pass, and it's to onboard SDAI as collateral. So SDAI is staked DAI that's earning 5%, and it's a liquid derivative of staked DAI. And the loan to value ratio is 77%. So and the liquidation threshold is 80%. And then right now Aave has its own stablecoin called Go, where you can borrow it at a fixed rate of 1.5%. So LTV of 77% loan to value means that if you deposit $10,000, then you can borrow up to $7,700 worth of value. And given the liquidation threshold is 80%, you only get liquidated if SDAI value falls to 9625. So this is 7700 divided by 0.8, right? That's how I get the math. But SDAI is literally staked DAI, right? Like it's backed by DAI, right? So like I don't really see this happening. I think I'm not saying that you should borrow 77%, like that's too degen, because there could be like some wonky things happening. But that's generally like what it means, right? This proposal, and it can create these looping strategies that can offer 10 to 20% rates if you wanted to. So if you loop it once, as in let's say you start with $10,000, you borrow $6,000 worth of Go at 1.5%, and then swap it for stake DAI at 5%, right? Then you have $15,000 worth of stake DAI with $6,000 worth of debt, and your entire position is yielding 7.1%, right? So like that's one loop, right? If you do that once. If you do it twice, you get 9.2%, and then each incremental loop increases the APR by 2.1%. And then if you do it 8 times, you can get like 20%. Like I'm not saying you should do this, right? I'm just like saying it's possible. This is going to be super gas intensive, but I'm sure that if these strategies start to become bigger and bigger, there's going to be new front ends to enable this with one click. And like let's say you loop it 5 times and you're earning 15% on dollars, right? On stake DAI. That's pretty good, right? And it's not coming from inflationary token like mechanics. It's not coming from like Ponzinomics. No, it's coming from tokenized T-bills. It's coming from the risk-free rate. And whenever these T-bills mature, the capital flows back on chain and it's creating value. And if you want to meme it, right, 69%, you can get these rates. But I mean, yeah, I don't know why I included that. I guess I'm still pretty immature. And so in terms of economic value, right, like Aave makes money, right? They make 1.5%. On the borrow, right, the Go stablecoin borrow, Maker makes money because they get to clip like whatever the difference between like 5% and the risk-free rate. And if not all staked, or if not all DAI is staked, then like not all not all DAI is like being utilized, and like like the difference in utilization rate means more like profits. I mean, that's kind of complex, like I suppose. And also like the end user makes money, right? Like I mean, like I would do this, right? Like if I make a bunch of money trading altcoins, which is very, very hard, then maybe I'm going to loop it 5 times and earn like 15% and then just go to bed and come back in like a month and, like, I don't know, like buy ETH with it or something. Yeah, I have no idea, right? And basically, right, it creates value, right? It creates value. And in the past, like the counterparty, if you think about DeFi, like old DeFi 1.0, the counterparty was like other crypto participants, like paying fees to use applications, but it's like not really creating value. Or like token holders, right? Like if you're printing new tokens, then it's the counterparty is basically like token holders because like I'm dumping your token to realize that yield. But in this case, the counterparty is the U.S. government interest payments, right? Like people are willing to pay Aave like money to borrow. People are willing to like use Maker to use the stake DAI product because I mean the money is flowing from off-chain sources to on-chain sources. So all these protocols are making money, right, including the user, and it's creating value, right? These are positive sum games. And I think these types of products are needed. And like, of course, like when this first launches, it's not going to be liquid. It's not going to be like amazing. But, I'm going to assume that, SDAI is going to be liquid on L2s at some point. All like money markets are going to integrate it because like, due to competition. And I think it's going to make for better and better products. And hopefully like, maybe like in the future base chain, like the Coinbase L2 can offer like, one-click leverage that like has like disclaimers that give people like a 10% yield. And, they say, okay, like SDAI earning this, you borrow at this rate through Coinbase Lend or whatever, like Aave. Yeah, you kind of get what I'm going for, right? Right. So summary: DeFi 1.0 fees come from other crypto people with with different steps. But DeFi 3.0 fees come from other crypto people and external yield sources, right? Because DeFi 3.0 it contains DeFi 1.0. It's just introducing a new mechanic around tokenized T-bills. And I argue that if people are making more money on chain, then like maybe they're going to spend that money elsewhere, and then other DeFi protocols can benefit as a result. Okay, so that's kind of the idea. And like I mentioned, right, the Go, it's under peg. It's like $20 million market cap. It's not liquid. But I mean, Aave is a blue chip. I think Go will get to like a multi-billion-dollar stablecoin like market cap at some point anyways. So it's not like this video isn't like, oh my God, like buy everything. It's going to pump. Like, oh my God, like we're so rich. No. It's to understand where DeFi is going, right? And to introduce this concept of DeFi 3.0 and how I think this is like what makes DeFi anti-fragile. I mean, there's even like one-click looping products already, right? Like, I don't want to give people PTSD, but like the mechanic here like wasn't like flawed, right? Like, I mean, you use interest-bearing like stablecoins as collateral, you borrow stablecoin and you loop it, right? I guess like the collateral like this time around was very fragile, right? But if you replace this with SDAI, then I mean, yeah, that works. And MIM is $50 million market cap, so it's like more liquid. But like maybe people aren't comfortable with it because of like all the drama. There's other like real world asset issuers like Frax, right? They're gonna introduce Frax V3, which is like tokenized T-bills. They're gonna integrate, or they incorporated a Delaware C Corp as part of their Frax V3 update. I have no idea when it's coming. I heard it's gonna be this month. Maybe it's next. I have no idea. But like they're closely tied to Curve, and then Curve Finance, they recently introduced like this one-click leverage, so it's like similar to the Abracadabra product, but Curve CRV USD is at $100 million market cap, so it's pretty liquid, and you can like borrow CRV USD, buy an asset, and like do the looping strategies I talked about. So we're kind of seeing like the base foundations being built, and maybe this is like less interesting, but just think about it. Like, I mean, maybe in a few months, like all these systems are more liquid, people are using it, and then like people can create like products on top of that, and like maybe, who knows, like maybe there's like a super staked DAI like 6 months from now that's earning like 10%, right? And you can LP super staked DAI with staked ETH, right? That's earning 5%. And then you're like LPing, earning fees, and the underlying assets are also appreciating. It's like, whoa, like that's passive income, right? Like, oh my God, like, we'll have people making TikToks about it. And we'll talk about, who knows that? Okay, like maybe we're too early, right? But that's kind of the idea. And going back to like Maker, right? I like these stablecoin issues right now because if you think about like the fragility of the current system and the anti-fragility of the new system, it's kind of dependent on these stablecoin issuers because they thrive in a high interest rate environment. And these DeFi projects, there's like questions around like regulations and whatnot, but they have ways to like deliver value back to its token holders, like unlike C5. For example, like Tether, right? Like whenever you buy Tether, right, or use Tether on centralized exchanges, you as a user get like 0% rates. But Tether, right, like they take the backing, buy T-bills, and they make $1 billion every single quarter. It's ridiculous. They're one of the most profitable companies in the world. And like, why wouldn't why don't we ask for why don't we why don't we like ask for this, right? Like, why don't we ask Tether, like, give me some of that yield? But as long as people use Tether and like don't complain, like they're going to keep doing this. And maybe this is too utopian in like my way of thinking, but I tend to be like optimist in nature by nature. But if DAI, right, stake DAI offers like 5% yield, right, like the base stake DAI, then if you think about it, they're kind of like looking to like vampire attack USDC, and maybe Tether, but like mostly USDC, because they don't give any yield back, because you can mint DAI with USDC, right? And if like when you do that, what does Maker do? They convert or they redeem USDC into dollars in the back end, and then with those dollars they buy T-bills. Okay, so like it's kind of like vampire attacking USDC market cap because it's increasing the amount of redemptions. USDC market cap is going down regardless, for like many reasons, but it's kind of similar to like the staked ETH argument of like, why hold naked Ether when I can hold staked ETH? Why hold USDT when I can hold staked DAI? And I think this is the question that I think people need to start asking more. And like not everyone is gonna stake like their stablecoin into SDAI, right? Similar to how not everyone that holds ETH wants to stake it for like staked ETH for various reasons. But I think this is like a slow trend that I think will come to fruition in the coming months. I don't want to keep saying good things about Maker. I do want to highlight its flaws and the risks. For example, like they buy T-bills through like off-chain entities that's not like managed by like the DAO itself. So when it comes to like transparency and reporting, it's like really flawed, and like it's impossible to know how much money like these entities are holding. Like in real time, right? Like it's not really on chain; it's like off chain. Like this real world asset report for June came out like the end of July, and like I read through this, and it's like not really clear, right? It kind of sucks. And like I guess like maybe I do. So the yellow line is the DAI market cap, and like this is like the Maker price. I do expect the DAI market cap to eventually surpass its previous all-time high, which was $10 billion. I really don't see like why it couldn't. And maybe it's like a good barometer of like Maker strength, because like in 2020 and 2021, DAI went up and then price went up. But I guess like, DAI peaked in like early 2022 when Maker was already nuking. But like maybe like back then Maker didn't really have value accrual, right? And like now they have like these buybacks that actually accrue value to token holders. So like maybe that can change. But it's not like a perfect token, right? And I think Maker is viewed as like the poster child of like bad DeFi tokens. So like maybe like I'm like just like not I'm like super incorrect in like my way of thinking, but I still think that if you look at the underlying fundamentals of Maker, I still think that it is like a good play for DeFi 3.0, and I still choose to allocate and hold onto this token. And there's this new governance proposal. So, this is pretty big. I think it's going to go live probably on Monday. And the TLDR is that right now, so I'll talk about the different elements of this proposal. But right now, like every 30 minutes, the protocol is buying back $5,000 worth of MKR, and they're pairing that with $5,000 worth of DAI. So with that $10,000 position, they put it into a Uniswap V2 LP position. And in the past couple of weeks, it purchased like $7 million worth of Maker, paired it with liquidity, and they have their own protocol and liquidity. And one of the proposals is to basically, instead of every 30 minutes, like let's do it like every 2 hours, and then increase the size from $5,000 to $20,000. So like nothing's really changing, right? So instead of buying $5,000 every 30 minutes, you're buying $20,000 every 2 hours. I mean, like the dollar value is the same. But I mean, it's like maybe this is kind of cool. I guess it's like bigger numbers. Maybe people like that. There's that. There's also, I guess, like fear and like FUD around, I guess, like the estimate of annual profits, because when I first made my Maker video, I think this was like 80 million and now it's 8 million. And it's like, wow, like the P ratio is so bad, right? Like, and it's making no money. But I also think that this isn't like the right way to think about it, because this is only, this is like an estimate, right? And it assumes that the DSR, the DAI savings rate, is going to be at 8%. But we know that this is only like, this was like a marketing like tool for like the Maker DAO team to like just go like turn this online for 2 weeks to just grow the market cap of DAI, right? I mean, it went up by $1 billion, and now it's going to lower it to 5%. And if you just, okay, so right now the amount of DAI in the DSR is 1.42 billion. Let's just round up 1.5 billion. The cost of the protocol at 8% is 120 million. Cost of 5%, 75 million. So when, like on Monday, the estimate profits should go up by like roughly $45 million, right? So, like, no, like this changes. And I still think that this is going to go up over time. And I guess another a point of concern is the system surplus. So the system only buys back Maker when the system surplus is above $50 million. So if the surplus right now is 54, then like the protocol itself only has $2 million worth of buy pressure for its own token. But I do expect this number to go up. And like this is like the flaw of Maker too, where if you go to like the real world asset report for June, like this column here is 23 million. So this is like how much interest like revenue that these off-chain entities have generated that has yet to, I guess, be added back to the protocol. And we have no idea like when, like where this money is, like when this is going to be distributed on chain. And yeah, like it's not like a perfect system. So like, can this really scale? I have no idea, but like maybe like this is how it starts, and then it like becomes more efficient over time. So at some point, like this is going to be this is going to be added back to here, which is going to result in $11.5 million worth of buy pressure, right, for the Maker token. And also there's this block tower Andromeda vault that can allocate up to $1.2 billion worth of treasuries, and they've only allocated like 600 million. So they can allocate like $600 million more. And if they do so, it's going to increase the like expected revenues by $27 million, right? So once the DSR goes down to 5%, it's going to increase the profit estimate by 45 million. And then once Block Tower deploys capital, it's going to also go by 27 million. So, I mean, like the thing is, like I said, like I have no idea when they're going to deploy this. It's up to them, right? And this is like one of the flaws, because I mean, like who are these people? And like maybe they don't have like the best interests for Maker at hand. But like I mentioned, right, like DeFi 3.0 as our framework, I think Maker is like the best tool to bet on that right now. But it doesn't mean that in 6 months it's still going to be like the best token to hold, right? I'm going to keep it fluid, right? I'm going to just monitor it like week by week, keep really close eyes on it. But I still like this token. So I think reasons for the correction, of course, the market nuked recently, but estimated profits down, system surplus down. Maybe people don't think about it that much, and it's like, oh, like bad token. But I think all three are just noise. And I think the bigger thing to focus on, or that I'm focusing on, is okay, like if like the recovery of DeFi is going to be led by tokenized T-bill projects, and Maker is leading that charge, then for now I'll allocate here, and then maybe in a few months, like some things will change, and then I'll reevaluate my positioning at that point, right? Like I'm like really digging deep into real world asset protocols because I think that's where most of the value is going to be. That's where most of the value is going to lie, at least like, in the short to medium term. And this is rare for me to say, but generally, like I haven't been a fan of like the MakerDAO governance model, and I'm still like not a fan, right? I talked about how imperfect it is, and this is Rune, the founder of Maker, and Rune also, right? People have mixed feelings about him, but I do agree because yes, like increasing like the DAI savings rate is not going to be good for profitability. It's not going to be good for token buybacks. Like token holders want buybacks now, right? But I also think that's like a short term, like a short term mindset. And I think it's bigger to like think longer term, right? Because the ultimate goal is for DAI to like vampire attack USDC and Tether, and to grow to like $100 billion DAI in the next 3 years. Like I'm not saying it's gonna happen, but I mean this is like what Rune's going for, and he recently like bought back a bunch of tokens. He's on like this benevolent dictator arc, and like I kind of agree with what he's going for, because right now growth is king, right? I do think that makers should focus on growing the DAI supply, and instead of focusing on short-term profits, let's grow like the project and then focus on profits later. I do agree, right? And then focus on like network effects, economies of scale, like that definitely makes sense. So another element of the proposal that I talked about is to increase the borrow rate, because right now you can borrow DAI for like 3.5%, and then stake it in the DSR for 5%, right? That's like bleeding value in the ecosystem. And this new proposal, right, that I talked about is gonna increase the DAI borrow rate to 5%. So there's like no more risk-free like arbitrage. But if you borrow DAI using like a MakerDAO like application called Spark, Rune is basically promising them like a retroactive airdrop of the Spark token. So technically you can use stake DEET as collateral, borrow DAI, stake DAI, and like make no money from like the stablecoin rate, but you will be earning like like free Spark tokens for helping out the protocol, or like increasing usage. So like maybe it's gonna create adoption, right? And like who knows? Like I have no idea what it's gonna do. But I mean, I would think that this would be like value additive, at least like to the to the DAI market cap. And I kind of want to summarize Rune's forum rant, because there's like, Rune talks about a bunch of things in these forums. It's a lot, right? His head is everywhere. He's like a founder, right? But ultimately he wants 10 billion market cap by end of year, 100 billion post EndGame, which we'll talk about. Buybacks are great, but let's focus on growth, and then use the 8%, 5% DSR to get more SDAI integrations, and let's grow economies of scale and network effects, similar to how with Lido and Stake DEET. Stake DEET doesn't offer like the best yields, but people still choose to hold it because it's the most liquid and people trust it. So I think that's kind of what Rune is going for, and it wants to be like the Lido of stablecoins, basically, right? And I actually agree with this vision for now. His endgame vision is kind of murky. I have mixed feelings about it, but like for now. So let's talk about endgame. It's a pretty interesting thing that they're going for, but TLDR, like there's going to be 6 sub-DAO tokens under MakerDAO. So with governance, right, there's MakerDAO and there's like 6 sub-DAOs that add value back to. It's like this pyramid, I suppose, right? Again, like maybe that's a bad wording. It's a triangle, right? It's a triangle. So there's 6 sub-DAOs under Maker, and they're all gonna have tokens. And the only way to farm these tokens is gonna be through a fair farming distribution system, where you have to stake Maker or DAI to earn these tokens. So basically, right, like whenever this thing comes out, end of this year, early next year, you can stake these tokens to earn more tokens. Spark is an Aave fork, and it has the most usage right now. I have no idea like what it's going to be valued at, but he talked about this in one of his threads. You can like borrow DAI to like retroactively farm the airdrop, and then once this token is liquid, you can also farm it by like staking Maker. So I guess it's more incentives to hold and stake these tokens, because you're getting additional yield. This is like just one example. Said you can only farm these tokens with these 2 tokens. Sub-DAO emissions will lower DSR costs, right? For example, if you can stake DAI to earn 10% in SPK, then technically they can lower the DSR to like maybe 2%. And then, like that's going to increase the maker profitability, which will result in more buybacks. So that's kind of cool. And also with EndGame, they're going to rebrand Maker and DAI, which I disagree with. But like Rune, like he spends his entire life. I mean, this is his life's work, right? And if he thinks it's like the best decision, only time will tell, right? People, there's like the I think crypto, like in general, like people like just criticize founders and like call them bad people. And sure, some founders are bad people, but like we need these founders, like we need to support them, and we need to like let them like innovate and experiment. And maybe if it's bad, like maybe Maker and DAI dies, or maybe who knows, like maybe it really helps with like TradFi adoption later on. Who knows? I have no idea. And like before I get in, so as we wrap up, like I do share like free research reports on H-Trade Research, and feel free to follow. There's a free newsletter. Link will be in the description below. I also created a new Telegram channel if you want to ask me questions, because crypto moves so fast. It's really hard for me to like make videos all the time, talking, following up on like things I've said like 2 months ago, 3 months ago. It's really hard for me to like just give general updates. So if you want to to ask me questions, you can tag me here. I can't guarantee I'll respond because I get spammed so often. But link will be in the description below. And also, if you want these research reports in real time, weekly videos, feel free to check out the premium Discord, Humble Farmer Research. You don't have to join, right? At this point in the cycle, at the current iteration of DeFi, this is more like a therapy session, right? Like we're all like just we're like, oh my god, like what's going on? But feel free to check it out. You don't have to sign up, but just putting it out there. I don't run ads and stuff, so that's. Anyways, like wrapping it up. Summary in terms of like where we are now and where we're gonna go. DeFi 1.0. It started the DeFi boom in 2020 with the compound liquidity mining campaign. Like inflation tokenomics, encouraging certain types of behavior. That worked, but it died when Fed started raising interest rates, and people started to like sell their Bitcoin and Ether. And then near the end of the peak bull market, we had DeFi 2.0, and like all these projects basically died, right? This is like just peak bull market phenomena where people were like just euphoric, and I don't even think DeFi 2.0 should be like a term, but I guess it's cemented in the history books by now, right? So I guess like the new era of DeFi, and this is like what the term I'm coining, right? DeFi 3.0, and I think the beginning of DeFi 3.0 happens when DeFi becomes anti-fragile via real-world assets. And I think we're going to start, or this movement is going to first start with the tokenization of T-bills, because T-bills, or if you tokenize T-bills, they're fungible, so you can integrate it with different types of protocols. There's going to be I'm sure there's going to be big real estate projects in the future, but that's kind of hard to integrate because they're non-fungible. There's stocks, but there's regulation issues, I suppose, and it's less liquid, and what's the value of trading stocks on chain, right? At least with tokenized T-bills, you can introduce new types of strategies. But I do think that the next phase of DeFi and the next bull market is gonna be led with the tokenization of securities, and with DeFi 3.0, we bridge off-chain instruments to on-chain, right? And then this way, DeFi is able to create positive sum games where economic activity and value is generated from real-world assets. Because DeFi 1.0, the yield and fees come from other people, but with DeFi 3.0, the yield comes from other people and also external sources. That's very reliable, right? What's the risk-free rate from treasuries are the most reliable sources of yield out there. So to add to bring that on chain and add financial engineering on top, I think can catalyze the beginning of the next bull market. And then who knows, maybe there's gonna be amazing new projects that come out or get launched as a result. But this is generally my idea. Even BlackRock's Larry Fink, he thinks that the tokenization of securities is going to be the next generational markets. So if DeFi were to get to $1 trillion in TVL, it's not going to just come from retail. We need TradFi participation. Are they going to be buying meme coins? Like, I don't really think so, right? Like, they're probably going to be like just deploying dollars into like tokenized T-bills, and maybe like, offering like more transparent reporting for their show. I mean, who knows, right? I have no idea what these TradFi people have in mind. But I think like your real world assets are going to become like the Trojan horse that begin the great capital migration from TradFi to DeFi, right? So real world assets is Trojan horse. DeFi takeover in the middle. Crypto promotes. Crypto talks about like, oh my god, like look at that. TradFi is like, oh, it's so good, it's so smart. Wow, like I'm bullish, right? Who knows? I have no idea. Who knows? But and so wrapping it up, this is something I want to talk about because I kind of get the sentiment from like people online that like the Bitcoin halving is gonna cause a pump because it's caused pumps before, and I think it's more likely to happen than not. But I think like if you just like view that statement, right, like that's hopium, right? Like we're just hoping that the halving leads to prices pumping. Of course, like the disinflationary supply of the coin like does matter, but it's gonna have less and less of an effect over time. And at some point, like until blockchains can create like real value for real people, like we're not gonna see like DeFi or like crypto just get big, right? So I even argue that like DeFi 3.0 has to happen for crypto to even like experience a bull run. There's also this hopium around like meme coins, right? It's like, oh, like retail comes back when meme coins start pumping. And I mean, I'm sure, right? It's like some people like love meme coins and like that's all they care about. But I feel like that's also a very condescending way to like view like retail and like people in general. Like basically like we're all retail, right? Like I don't like invest in angel rounds. Like I don't, like get paid money. Like I don't really have like inside information, right? I'm like just out here like just grinding away, looking for like any sources of value like on this blockchain, like similar to you, right? And I think it's more likely that these new types of like DeFi products like onboard more people instead of like meme coins, right? Because like meme coins only target like a specific type of like psychographic of a person. And I think more like most people, right? They want to like invest in things that they see value in. And right now there's not much, unfortunately, there's like not much of value in crypto, right? I think there are slivers of value, right? And like I'm like allocating capital, and like in the DeFi 3.0 as a framework, right? So I'm like, okay, I have this framework, and I'm gonna invest accordingly, farm accordingly, because if new tokens launch, new projects launch, there's gonna be farming opportunities. I'll farm that instead of like some random DEX fork on Coinbase L2, what, right? So I don't know, like I feel like instead of relying on hopium around halving and like meme coins pumping and like using those people exit liquidity, like let's build better products, right? And like use the government interest payments as like exit liquidity, right? Like imagine like we're staking stable coins, we're dumping the yield, right, to like buy stuff, right? We're like dumping the government payments for income, right? It's like Maker is using the government interest payments to like buy back its token, right? It's like let's use the government as exit liquidity. I don't know. I mean, people get upset by like that lingo, right? It's like, oh, like government is like bridging money on chain, like buying our bags, but it's a meme, right? Like don't take it too seriously. The point is, right? Like DeFi 3.0, like real value, right? Real value. Instead of money going from one person to another, let's have like more ways to generate value. And yeah, I think that's. Oh yeah. So lastly, I'll talk about regulation risk. And as we wrap it up, of course, how legal are like tokenized T-bills, right? It's like not KYC, yada. But like how legal is like most of crypto really? And I think when it comes to companies and projects to like enter people's like headspace and like mindshare to actually gain adoption, I kind of think of like the Uber example, right? Because like when Uber first launched, they didn't ask the government for like permission, right? Like they just started like signing up drivers, and at some point there were so many drivers that the government couldn't really say no to Uber because it was like the livelihood of like so many people. And maybe like that's not like a great analogy, right? Because I guess Uber drivers like actually like make a living and stuff, and like maybe like like T-bills like maybe it's cool, right? But like maybe it's like who knows? Like basically what I'm saying is that like I think it's more important for crypto projects like focus on growth, and then just like create such a good product that, like if the regulators like want to step in and say no, like the regulators have to be like, well, like if we like say if we do XYZ, then it's gonna like damage like the markets too much. It's like it's not gonna be great. So instead of like shutting down this project, we'll like make new regulation or like new legislation that says, okay, like maker, like okay, like your current model is like not good. Okay, like if you want to continue operating, you have to go through ABC, right? And then maker's like, okay, I'm so sorry, right? And then they go they go through these additional steps. It might not be like a clean transition, but I think generally like if you're in crypto, like it's if you're like just like worried about regulation all the time, I think it's really really hard to like just remain interested. Like maybe this is like a bad take, but it's my take, right? It's my video, it's my channel, so you're gonna get my take. And like I mentioned, right? Like I mentioned near the beginning, DeFi 3.0 as a framework, don't focus too much on like the maker token itself. Just think of that as like how I'm perceiving the markets right now. I think I've come to the conclusion that going back to this first, how many slides is this? It's 77. Okay, 77 slides. That's a lot of slides. Going back to this original question around, doesn't DeFi seem kind of dead right now? If you think, or for me, I thought about. I mean, I think about this way too much. But if I think about this like in a more fundamental reason or fundamental manner, it's like, okay, like yeah, like DeFi, if you think about it, it's not an anti-fragile system. And then I thought about, okay, like how do we get to anti-fragility? Well, like the reason DeFi is fragile is because the risk-free rate is too damn high. So I think for DeFi to be anti-fragile, we need to bring the risk-free rate on chain. And then, if interest rates remain high, then DeFi can compete. If Fed cuts interest rates, well, technically that should potentially like increase like or raise asset prices, right? Because like the discount cash flow model, etc. And then like maybe that can lead to like a DeFi bull market on its own. So no matter what the interest rates are, DeFi can survive. Therefore, it's anti-fragile. When the markets are volatile, right? These platforms can make fees, and the fundamentals look good. That's cool. But if fees are low, well, at least there's yield to be had from real world assets. Okay, so anti-fragile there. If people are risk on, like everyone's like celebrating, right? Everyone's high-fiving each other. But if everyone's risk off, no one uses applications. Well, maybe, but they can stake stablecoins and earn like 10%. Okay, like that's an anti-fragile system. So that's kind of where my head is at. Let me know what you think. This video is approaching 50 minutes, and I'm getting very, very tired. I need to eat lunch soon. Okay, so I'll wrap it up there. So thank you guys for watching. If you don't mind, right, just try leaving a like if you like this idea, right? It's hard being a content creator out here. You don't have to subscribe to my premium Discord. You don't have to join my Telegram. You don't have to follow me on Twitter, right? Like, if you just like the content, just like it, okay? Like, Taiki needs some wins too, like we're all the DeFi people, the DeFi bros, like we need to support each other like while we can, right? So let's wrap it up here. Thank you guys for watching. See you guys another time. Bye bye.